I like to move it. I like to move it. You like to move it.
Welcome to another episode of I Like to Move It, the Rulmeca podcast, where we discuss the most relevant and interesting topics related to material handling world. I'm your host, Mr. R, and I'm very excited to dive into today's topic: raw material cycles, current situation, and future trends. Raw material cycles are the fluctuations in the supply and demand of natural resources that affect their prices and availability. They are influenced by various factors, such as economic, developmental, and technical cycles, as well as geopolitical events, environmental issues, and consumer preferences. Understanding these cycles is crucial for investors, producers, consumers, and policymakers who want to make informed decisions and anticipate future scenarios. To help us explore this topic in more depth, we have a special guest with us today, Tim Clark, the head of mining research for SBG Securities, a division of Standard Bank. Standard Bank is the largest bank on the African continent and is deeply involved in supporting clients in the mining, manufacturing, and commodities sectors. Tim has been a mining, paper, and commodities analyst for nearly 20 years and specializes in bulk materials, base metals, energy, and paper markets. Tim covers the large global diversified and South African diversified mining companies, as well as South African listed paper companies. Welcome, Tim, and thank you for joining us.
Thank you for the kind introduction, Mr. R. And thank you for allowing me to share a few thoughts on the topic of material handling and about commodity markets, demand, and mining of material.
Let's start right away with the first question. We often hear about the commodity cycle. How do you think about commodity cycles?
It's a very interesting topic as to how we think about commodity cycles. It's a question I get asked very regularly. Where are we in the cycle? And it's taken some time for me to realize that it's not a very easy question to answer. Over time, I've realized that I think it's best to think about cycles in categories, and certainly I've divided it into three specific categories. There's firstly the economic cycle, secondly developmental cycles, and thirdly technical or technological cycles. So let's run through each one of those one at a time. The economic cycle is the most familiar to all of us. We've got rising inflation caused by strong demand, resulting in higher interest rates, causes demand to slow down, and we run through a normal economic cycle. And as economic cycles play out, demand for materials follows cyclical demand and drivers of demand. Where are we in the cycle today? We're probably right at peak interest rates, and so we're in the latter parts of that demand cycle. The second cycle, though, has until recently been much more relevant and certainly more important to commodity markets, and that's the developmental cycle that we've seen recently in China. Let's talk about developmental cycles. What are they? Basically, they are the urbanization and industrialization of economies and the move from rural environments where commodity consumption is relatively low to build inventories into cities, all the way from owning an apartment and riding on an escalator to driving a car and traveling on a train. All of these things are commodity intensive, and they require a significant amount of commodity, which is beyond the normal economic cycle of demand. We've really, if you look back, had a number of these events over time, but the most significant more recently are the United States from the late 1800s to the 1960s, Japan in the 1970s, the Asian tigers through the 1980s and into the early 1990s, and then the really big super cycle where the biggest urbanization event that we've ever seen happened in China, and developmental industrialization event happened in China from the late 1990s and all the way through to today, and demand remains strong up to today. There's a third cycle, though, and that's really interesting and really exciting. And those are technological step forward type of cycles. In technological cycles, something has to change in the way that we live as a society, or something has changed, which results in significant amounts of demand for commodities and for materials. The current environment of energy transition is highly demand intensive for commodity markets and for mined materials. You're not going to build out renewables. You're not going to redo the electricity grids. You're not going to replace all of the transportation fleets without significant commodity demand. And I think we plan to speak about these through some of the podcast series, and hopefully we can unpack into a little bit more detail.
That is a very interesting perspective. Speaking about the current economic cycle, there are reports of recessionary risks this year for most of the developed world. Though shallow and limited, how are you thinking about the economic cycle at present, and what is the outlook?
Let's start with recession. Recessionary conditions are by definition backward-looking. Recessions are declared when we've had 2 quarters of negative growth. And certainly there are indications of this emerging as we speak right now. But as I point out, it is somewhat backward-looking. I think when we talk about recessions, we must differentiate between inflation and demand. So let's talk about inflation firstly. Inflation peaked, especially with energy prices, and caused the rising interest rate environment as central banks tightened over the last couple of years. But certainly inflation has turned and is falling, and as a result, rate expectations are likely to see falls or drops in different quantums over the course of the next year or two. Demand, though, is a little bit different. Demand has been relatively weak for materials in Europe. It's slightly less so in the US and Japan. In many ways, the IRA and other stimulus events have held up those 2 economies in terms of a normal economic cycle. We do anticipate that as rates come down, European demand will recover. And certainly there are indications of restocking and of better order books coming through in Europe, and the outlook does look more positive. From a US-Japan point of view, though, I think there will be some support, but the base is a little bit higher. So as we think about recessionary conditions, we expect it to be fairly shallow. We expect demand to start to recover, certainly from the second half of this year.
Do you think commodity prices are reflecting the current point in the economic cycle?
In simple terms, the answer is probably no. At this point of the demand cycle, which is relatively weak, we'd really be expecting prices to have moved from an incentive or an inducement price towards a cost curve intersect. And we are seeing some sort of cost curve intersects coming through with manganese, thermal coal, nickel, aluminium, and PGMs. But they're right at the top end of the cost curve, so they're not very deep into the cost curve. And certainly in normal recessionary conditions, you fall down towards, let's say, the 90th percentile of the cost curve. We're not there right now. There are a couple of other commodities or commodity baskets which are better supported. Copper prices are trading well above the cost curve, but disruption levels are very, very high. We had 2 major events with Cobre Panama and with Los Bronces cutting production last year. Massive disruptions coming through in copper, and the inventory levels are very low and hence well supported. The market also knows that energy transition is coming, and so it's a bit of a mug's game to bet against a strong demand outlook. The other one is steelmaking raw materials. Steelmaking raw materials have been better supported. I think it comes from strong steel demand, which is flat out of China at around about 1 billion tons, just a little bit over 1 billion tons, but then also growing steel demand coming out of India. So, in answer, probably at this point in the cycle, we would normally have expected prices to be a little bit lower than they are. But there are good reasons why they're well supported, and with relatively low inventories across the board, certainly the outlook does remain supportive.
How does the outlook for the dollar and Fed rate cuts impact commodities?
The recent March inflation data out of the US was an increase month on month and was somewhat sticky. The result is that it's unlikely that we'll see a rate cut before June by the Fed, and also the likelihood of back-to-back cuts thereafter seems to be less likely. But I think what is important is to note that we're moving into a rate-cutting cycle. And in a rate-cutting cycle, the dollar tends to weaken, and demand outside of the US, therefore, sees lower commodity prices, and it's generally supportive of demand. In addition to that, a new phenomenon has emerged, really, and that is the financing of commodity markets on a derivative trade type of basis and an ETF type of carry basis, which results in the fact that lower interest rates do create demand for commodities naturally. And so certainly the outlook is somewhat more positive as rate cutting cycles commence and as the dollar weakens.
What about in the longer term? You mentioned developmental and technical cycles, which we plan to discuss in a later podcast. But as a teaser, what are you thinking?
To be honest, the economic cycle that we've been speaking about has actually lost some of its luster since the emergence of China in the late 1990s. just to put some context to that, China's gone from 36% to 66% urbanization, or even higher, from 2000 to 2023. And the degree of industrialization is in the high 80%. China's central planning has allowed construction of infrastructure ahead of demand. And as a result of this, it's the largest, just taken into account there are 1.4 billion people in China, and fastest development cycle in history, because infrastructure, cities, factories have been built ahead of demand rather than as a result of demand. China's also risen from a negligible level to around about 40 to 60% of world commodity demand over the last 20 years. But in truth, this trend is really maturing. Debt levels are higher in China, industrialization and urbanization levels are peaking, and China's starting to transition towards a consumption and a services type of economy, far less commodity intensive than the infrastructure, real estate and build that we've seen over the last 20 years. But demand does still remain relatively well supported at these levels. We're going to discuss China in detail in a later episode and also introduce India's emergence as a developmental demand driver. There's some really exciting advances from India coming at present. At the same time, energy transition is a highly commodity demand intensive, and we're at the early stages of this emerging megatrend. And we'll discuss that in a later episode. So I guess in conclusion, economic cycles are getting a little less relevant or important, but we're right at a turning point on those. China has been a massive driver of commodity demand for the last 20 years or more, and we're at a peak and maturing level in that developmental cycle, and we're right at the transition towards new demand on a global scale from energy transition.
Thanks, Tim. These are very interesting perspectives on commodity cycles and on the outlook for the year ahead. We look forward to discussing China and energy transition in later podcast episodes.
Thanks, Mr. R.
Thanks again for listening. We'll see you next time on I Like to Move It, the Rulmeca podcast. Thank you for your attention, and I look forward to seeing you next time to explore together again the most interesting new trends and developments in the world of materials handling. Take care and keep being awesome.
I like to move it, move it. I like to move it, move it. I like to move it, move it. You like to move it.